went through that. Here's the disclosure. All the states that we're registered in. Obviously, investing involves risk, including potential loss of principal, all that good stuff. No investment strategy can guarantee a profit or protect against loss in periods of declining values. This is also at the back end of the presentation as well. So topics I want to go over today. I'm always going to kind of start with the bullish versus bearish arguments, list kind of the top 5 for both, and we'll go through some of those each month. Do a quick volatility analysis. I know last month I did mention that will most likely be a part of every single presentation that I do, just because volatility is such an important aspect of investing. Interest rates as well. Talk a little bit about that. Talk about kind of bubble comparison, right? I think there's so much talk right now about are the markets in a bubble territory and things of that nature, because we've had this huge run. So I know I touched upon that last month a little bit, but I actually want to show some comparisons of some previous bubbles, like NASDAQ, the Shanghai Composite back in the mid-ish 2000s, Japan back in the late 80s, and then the dot-com bubble. And then look at a few things against that we talked about last time as well, offenses versus defense, right? Kind of the risk on assets versus risk off assets. I want to kind of go over those and kind of show what's going on there. Is the market still showing some strength? Is it showing a little bit more, declining momentum, things of that nature? So bullish and bearish arguments, right? Very similar to last month. I mean, you wouldn't expect that to change too much on a month-to-month basis. So global awakening, talked about that last presentation, where a lot of, yes, the U.S. markets have had a huge run over the past, 15 years or so. But if you look at it from other countries, some of them haven't still made all-time highs. Some of them are still just getting there. So, the rest of the world is kind of behind the U.S. from an equity market aspect over the past decade, and some of them are really starting to pick up. So global awakening means we could see a lot more rise in equity prices globally, even if the U.S. does slow down a little bit. Momentum is still strong, but it has declined over the past month. We reduced risk a little bit over the past month in our managed accounts here, and we're okay to do that. We're having a really, really good year so far, so we're totally okay with taking a more cautious approach. But momentum has certainly declined a little bit, and especially the NASDAQ. I mean, the NASDAQ has basically just, not fallen off a cliff or anything like that, but in terms of what it's done over the past few months, it's really had a little bit of a pullback. Low interest rates, which is good, but they have risen, and that has caused a little bit of not market shock waves or anything like that, but a little uncertainty. We've seen volatility has picked up again a little bit, and the market's had a few days where it sold off, and it really seems to be tied to the rise in interest rates and people's fear of some potential inflationary forces. Global asset shortage, I talked about that last time. If somebody has a question on that, I can get into that at the tail end. And then recent consolidations, in the sense that, yes, we have had a good run of the markets, but it hasn't been straight up, right? We've had some consolidations which have helped kind of keep the market in check. Bearish arguments, you could make the argument that U.S. equity markets are a bit stretched. Volatility definitely remains high. The VIX started this week at, I believe it was 28. Right after our call in February, right after that webinar, I believe that was the week the VIX dropped below 20. It closed the week below 20 for the first time in over a year. And then the next week it jumped right back over 20 again. It was 20. It started the week at 28. I believe as of today, I think it's at like 24. But that's still pretty high, historically speaking. Signs of reckless investing. There's just a lot of, the whole Reddit community and GameStop and, everything going on in the crypto world and things like that. And I'm not suggesting that, all of those are reckless, but there's just a lot of euphoric investing going on. Rising interest rates, that's much more of a short-term thing that's kind of been happening over the past couple of months, which is, just raised a little bit of uncertainty. And then COVID variants, I think, until that just completely kind of goes away as best as it can, anything odd that happens with that, you just don't know if it's going to throw a wrench into the system for a month or two. So just always something to kind of keep our eye on. So this is the first one of the things I mentioned was the VIX, right? And we went over this last month. The VIX is the volatility index, right? It measures the 30-day expected volatility in the market, right? So it's It's really, if the VIX is rising, then you have to assume that you're going to see continued volatility. You don't want volatility, even on the upside. You don't really want volatility in the market in general, because the largest up days in the market typically coincide with the largest down days in the market. When volatility is really high, it happens on both sides. And I'm going to show you guys a little bit in a few charts from now, one of the other tools that we use to kind of look at volatility. But you can see, it's just still not low enough to feel really comfortable. It, like I said, it did drop down to 20 at a weekend in February, and then jumped right back up. And we really want to see volatility in these levels: 2017, 13, 14 areas, those mid 2000s here, and then obviously the 90s. Those are time periods where volatility is really low, not much to worry about in the market. Typically screams forward. And I showed you guys this last month as well. One of the risk measurement tools that we use, the gray shaded areas, are times when the VIX shoots over 30 and is showing positive momentum, and those are times to de-risk, right? Those are times so that the top line is the S&P 500, the bottom line is the VIX. So the bottom line is just the VIX, which is on the previous chart, just minimized, so I could fit both of these on the same graph. And I think the VIX, utilizing volatility for your risk management process, I think is one of the best tools to use. And we use it, and we measure it in 3 different ways. And it's a great tool to use. And so we really want to see this drop down, right? I mean, you look at where it's at now, and it's even in those time periods where typically you would de-risk. It's not showing positive momentum, which is why we haven't de-risked based off of volatility at this time, but it still is really high, and we would really like to see it get down here. So I don't know if it's because, maybe because of COVID, maybe because just, really low interest rates. I don't know the exact reasons why the VIX refuses to kind of, stabilize to a lower number, but it is what it is, something that, you want to kind of stay on top of. This is the VIX, just a closer look at it, right? And so this is where the week we started here at 28. Really want to see it come down. I mean, if you look at, like, again, I'll always reference 2017 as like one of the best years to invest because there was just no volatility at all. And you can kind of see where it was then. And so looking at it, even at 20 is still a really high level. I mean, this is the fourth quarter of 2018 when the market sold off by like 22%. And, that's, we're right around those levels right now. So really want to see that come down. So here's the S&P 500, okay, on the top. This is another way to kind of measure volatility. The bottom line, it's a 1-day rate of change, okay? And so if the 1-day change is 3%, it's going to plot a 3% green bar to the upside. That's what this is, right? And so if on a particular day the market's up 10%, you're going to see a big spike. That 1-day rate of change, right, is going to be up 10%. There's a big spike. And so you can kind of see, right, that the wider this band gets, so the wider that this band gets to both sides, the upside and downside, right, those are times that you really don't want to necessarily be 100% in the market. Right. So even upside volatility, I know a lot of people, there are some studies done kind of really from more so the buy and hold community. They use a statistic out there when talking to investors about if you miss out on like the top 10 days in the market, right, over, the past 20 years, it cuts your performance down by like an average of like 2% like a year or something like that. I don't remember the exact statistic, but it's pretty significant. And so that's their whole thing, is why you always want to stay 100% invested, because if you miss out on those really big days, you're missing out on a lot of gains. And yeah, that's true. But what they leave out of that description is those really large days coincide with the really large down days as well. And so the other way to look at it is say, sure, you may miss out on, some major up days here, but you're also missing out on those really large down days. So trying to manage the risk is, I think, the most important factor with that. And so with this, you really want to see these type of time periods, right? Really, really narrow band dispersion, right? Narrowed band dispersion here. Again, this is that 2017 time period. And we're not really wide here. We're not huge. We're not going 4% every day in both directions. But it is still a little bit wider than we'd like to see. We'd like to see it more like this, more like this. And the other issue too with this, with the current time period, is you can see there are some spikes to the downside, whereas there isn't as many big spikes to the upside here. So it seems like the major, from a standard deviation aspect, the ones that are, you know, greater on the standard deviation, continue, you know, to be to the downside. And so, you know, I think that just kind of coincides with where we are from a volatility aspect. I'd like to see both of these things, you know, to really say, hey, I think things look great for the next year and a half or whatever. Really like to see the VIX fall. And really like to see this kind of, you know, this band kind of narrow a little bit. So this is the exact same thing, just a little bit of a closer look, right? Just the other one was from like looking back 30 years or so. This is just a little bit of a closer look. So nothing new, just a little bit of a closer look. Again, you can see this is a little bit more narrow than, you know, this time period, 2017, the 2013, 14. So just want to see that, you know, get a little bit more narrow there. Let a really quick look at interest rates here, right? So interest rates going back to 1981 when they peaked. We're still like historically low, and you know that theoretically could be a really good thing for the equity markets, and I think that's one of the things that's driving money into equities. But you know the problem is, you know, you don't want to be too low for too long. That obviously, you know, not a good thing. You don't want to go negative. That's, you know, Japan, they never really recovered from that. The other thing too is, you know, we've seen this big spike over the past 6 months or so, and it's put like I mentioned, it's had a few scares in the market because of that, and it's had a really bad impact, really negative impact on the bond market. The bond market over the past 6 months has been terrible. I mean, it's been really difficult to make money on the bond side. We've been predominantly in senior loan funds and high yield bond funds, and so we've done okay. You know, better than the benchmark from that aspect, but it's still been really difficult. And the reason high yield's performing well is because such a large percentage of high yield bonds are made up from the energy sector. And obviously everybody knows, you know, oil prices have spiked over the past few months. Energy companies have, you know, the equity from the equity side have done really well. So that's helped out the high yield market. But the bond space right now, it's challenging. I mean, treasuries have gotten absolutely crushed for the past few months. So it's been pretty challenging. This is just a closer look here. You can see, like what I was talking about, the past 6 to 8 months here. You know, interest rates have really spiked, and ever since really they shot up from this point right here. That's where people are starting to get a little bit nervous. And look, we're still really low, but people are looking at it and saying, okay, well, if they get to, you know, 2.5 or 3%, that could cause an issue. If you look at what has performed really well in the market over the past 6 to 8 months, a lot of the asset classes are inflationary related, right? So energy, agriculture, you know, food prices, real estate, you know, things like that. A lot of emerging market funds have done really well. There's a lot of inflationary forces going on, and so people are looking and saying, with that coupled with, you know, interest rates creeping up, is that going to cause some issues down the road, or even in the near term? So that is something that we're paying attention to. We like I mentioned, we've had you know, quite a bit of exposure to high yield and energy. I know we're in a few oil names as well right now, and it's, you know, simply because of those reasons. So I was talking about how the bond market has had a really difficult time period for the past 6 to 8 months. You know, the top line here is AGG, and that's basically, AGG is essentially like it's like SPX, but for the bond market. It's the bond index, the Barclays Bond Aggregate Index. So it's, you know, that's really the barometer that people use to measure the bond market. And then the bottom line here is TNX, which is the 10-year note, the Treasury yield 10-year note. And, you know, you can see as you know, interest rates rise, bond prices fall. I mean, they're inversely correlated, so that obviously makes sense. And so one of the concerns is if interest rates continue to kind of spike here, you know, how much more pressure is that going to put, you know, on the bonds? And people go into bonds, you know, that's the safe part of people's money. So it's, you know, it's a challenging environment from that aspect. So I hope interest rates can kind of stabilize here a little bit more, and, you know, that spike kind of, you know, comes down. I think they will. I don't think with how much debt that our country has and it's tied to those interest rates, I don't think we can really allow interest rates to get too high. So I don't see interest rates getting to 3 or 4% anytime soon. But it is just something to keep our eye on. And what we don't want to see, you don't want to see a huge drop in interest rates like that fast. That's not what you want to see. You also don't want to see a huge spike. You'd like to see a little bit more. A little bit less volatility from that aspect. So I mentioned I want to kind of talk about, bubble territory, right? You turn on, the news stations or you read newspaper or just talk to people. It's like, oh my gosh, we're, the next bubble's a few months, around the corner and the markets are going to implode and all that stuff because we've, since the financial crisis, we've had this huge run. And again, that's true, right? We're up about 460% since the bottom in March of 2009. And I went over this last month. But there've been a lot of corrections along the way. It hasn't been straight up. So not at all like the 90s where it was, clear sailing until late 98 where a huge hedge fund blew up, and then it went on for another 2-year bull run before the dot-com bubble. We had the flash crash, US debt got downgraded, earnings meltdown, interest rate uncertainty, and then COVID. So it wasn't just a straight shot. And so I want to kind of compare when people talk about bubbles. I want to look at, okay, well, let's look at the US equity markets. Let's compare that, right? Let's go ahead and compare that to some of the other bubbles that have happened over the past 30 years and look at it from a percentage aspect, right? So here's the Nikkei right before it imploded back in late 89. And so here's the 2 years prior to it imploding, right? It was up 77% in those 2 years. And then it obviously had a huge corrected over the course of a really long time period by like 80%, and still hasn't fully recovered. But those are the types of returns you typically are going to see, before a huge market correction like that, right? Something like that. And we're just not there from a full U.S. equity market aspect. The NASDAQ actually kind of is, and I'll get into that. This is the Shanghai Composite right before the financial crisis, up 416% in the 2 years. 2 years before it fell from the financial crisis, up 416%. Like that's euphoric, right? That is like bubble territory written all over it, very euphoric. We haven't seen that type of investing yet. I think we're seeing signs of it, but signs of it, when people talk about the markets imploding and entering bubble territory, you kind of relate it to baseball and say, okay, well, what inning are we in possibly? You might be in the bottom, you could be in the top of the ninth or bottom of the ninth, but that inning might be really long, right? So we could go 2 more years before something drastic happens. It just really depends. It really, you want to follow the data on that. So even if we are kind of in a euphoric stage, you go back to like the late 90s and people were saying that there was going to be a stock market correction in like 97, and it went on for 3 more years. And so you just never know. But I don't think, if you look at the S&P and even the NASDAQ, like they don't look anything like this. They don't look like they're not up 400% in the past, 2 years. Now it's a little bit different because the Shanghai Composite, China's an emerging market. So they're going to have those types of runs much more consistently than a developed market like the US is. But still, we're still just not showing, those kind of signs right now. This was the NASDAQ in the 2 years leading up to the dot-com bubble, up 283%. That's huge. Now, again, a little bit different time period because the internet was new, and it's, companies could essentially write down their, the company name and what they plan to do, and they could go get funding and, create a stock and go public. And that's not really the environment anymore. But again, you do see a lot of euphoric investing in certain things right now with, I think a lot of people just think that, it's easy and you just throw money in the market and stocks always go up and things of that nature. And it's just not accurate. And so when you start to see that kind of reckless investing, it definitely makes you kind of perk your ears a little bit and want to dig a little bit deeper to kind of see, okay, well, are we reaching those stages yet? And I don't think we're there yet, but I think it's, the stuff is worth paying attention to. And towards the end of the presentation, I'll kind of get into why I don't think we're there yet. And then here's the S&P 500 over the past 2 years, right? Obviously, we had that huge drop in COVID, so that that during COVID that hurts the full kind of return data. But that also it certainly corrected the market too, about 36% in the past 2 years, which is great. That's great. But that's not really bubble territory. I wouldn't classify that as that. I think if we were to go through like a 6 month phase where the market went up by 35 or 40%, I think at that point, then that would definitely change my mind. At that point, I would probably look at it and say, okay, like there's a really good chance that we're going to have a really big hurdle here sometime soon, and probably want to head for cover a little bit, but just not there, in my opinion. Here's the NASDAQ though. It is up 88% in the past 2 years. So technology stocks. Now that certainly was helped because technology, once COVID happened, technology, so a lot of technology stocks actually still performed well during that time period. And then after for the 5 or 6 months at the bottom here from late March, they just absolutely ripped. I mean, obviously, companies like Zoom, which is what we're on right now, right? I mean, they just absolutely crushed it. So up 88% in the past 2 years, which is a lot. And that is a little bit sign for caution. But you can see, look what's going on in the NASDAQ, right? I mean, it's had a really big pullback here over the past, 3 months here. And so, I mean, I put not surprised at all, right? Up 88% in the past 2 years. Yeah, not surprised at all that it's had a little bit of a drop. I mean, every week I kind of continuously, I rank all the sectors and things like that. And tech has continuously been at the bottom for the past few months. We haven't really owned much technology since I think September. And I'm continuously not surprised just because of the run that it had. It's like, yeah, it had to cool off. Like that makes sense. You probably don't want to be in technology right now. Just it had a huge run. It needs to kind of, catch its breath. And that's how investing works. You'll see pockets that, heat up, and they're great to be a part of. You want to be in the early parts of those, right? I mean, people, if you knew a bubble was going to happen in 2 years, well, that'd be great. You should ride it out for 2 years. Try to. I mean, so like in the NASDAQ, same thing. Like that's great that it had a huge run. Be a part of it. But once the relationship starts changing and things start to show more of a risk-off environment within those sectors, time to kind of get out of them. So this is one of the tools too that we use. And I went over this a little bit last month, and this is how most people look at two different securities, right? They plot one and the other on the same chart. The blue line is XLP. XLP is an ETF. It's consumer staples. So some of the top holdings within that: Pepsi, Coke, Costco, Procter & Gamble, and Walmart. Those are all consumer staple stocks, right? So when the economy goes through a recession, or the market has a major correction or anything like that, consumer staples is typically, they're defensive in nature, right? Because we're always gonna use, we're always gonna utilize Walmart and Procter & Gamble. We're always gonna be going to Costco, buy water and paper towel. People are gonna buy Coke and Pepsi products, right? Regardless of whether we're in a recession, those are gonna typically hold up better. Not to say that they're gonna go up if the market's going down, but they're defensive in nature. And so kind of comparing which one of those is performing better. And again, so this is the two securities on the same chart. And what we do typically, we'll divide one by the other, right? To get a better viewpoint and to see which one is outperforming in kind of the turning points. And so this is the S&P 500 divided by consumer staples. If the line is rising, okay, it means the S&P 500 is outperforming consumer staples. Now, they could both be going up, right? They could both be going down. It just means the S&P is outperforming consumer staples. And so really what this is to show is that when consumer staples start outperforming the S&P 500, it's saying that defensive stocks are more in favor in comparison to non-defensive stocks, right? And so you can kind of see that relationship. This time period right here, consumer staples were outperforming the S&P 500. Okay, that's the dot-com bubble. Consumer staples were outperforming the S&P 500. Financial crisis. Consumer staples outperforming the S&P 500. Right? I drew those kind of red lines in there. Interest rate uncertainty. This is the fourth quarter 2018. Was right here, and then obviously COVID. And so you can see that in like right here, like consumer staples started outperforming. mean, the market peaked out right around here. The S&P. It was October of 2007, and that relationship this kind of stalled out here initially, and so it's interesting to pay attention to. It's not like the day that the market peaks, consumer staples are going to start outperforming. Usually, it's going to happen a little bit before. It's usually kind of a warning sign that hey, the more defensive stuff is starting to perform better now. Time to kind of start paying attention to really what's going on underneath the hood. So it's another thing that we utilize to kind of see, risk on versus risk off. It still looks good. I mean, you can see where we're at right now, right? This is where we're at. I mean, this does look like, okay, well, that's pretty stretched right there. So maybe this could change here shortly. We'll see. But as of right now, the relationship still looks, if you had to classify it, risk on versus risk off, I'd say it's risk on. I mean, S&P 500, outperforming consumer staples. I know last month I showed everybody high yield outperforming treasuries, and that's more of a risk on, risk off in terms of the bond world. Everything is still showing risk on right now. I think there's some issues, some underlying things to pay attention to, but everything is still saying that, hey, equities look favorable right now. This is another one. This is just the essence. It's the exact same thing here. It's just gold. It's the S&P 500 divided by gold. And so this is actually one of the things that I use, that I analyze on a weekly basis. That's in our kind of risk management strategy that we utilize to tell us how much risk to take, on a monthly and weekly basis. And you'll see that. I mean, it's the same chart. I mean, it's I think this one I only went from the financial crisis, but it's the same time periods, right? I mean, so it's like when you see kind of a weighing of the evidence, if consumer staples are outperforming, right, the S&P 500, and gold's outperforming the S&P 500, and treasuries are outperforming high yield, that's a time period to get defensive. Like that's a risk off environment. That is a time period to start, allocating into things that, either going in a little bit into cash or more money into bonds or, some currency plays. There's a million ways to kind of do that. But those aren't times to go pedal to the metal. Now, if the S&P 500 outperforming consumer staples, it's outperforming gold, and high yields outperforming treasuries, which is the case right now, then yeah, you want to be a little bit more risk on. It's okay to, take a little bit more risk. It's not to say the market's going to go up every day. We're always going to have those corrections. We're always going to have those, 5%, 7% corrections. Those are difficult to get out of the way of. Those can happen in, 2 or 3 days. Really what you want to try to do, you really want to try to avoid the major large, drawdowns. You want to try to avoid the 30% drawdowns, 40%, 25%. Really, that's what we're trying to, make sure we sidestep as best as we can. So all of those things kind of all get thrown in there. And it's like I mentioned, it's kind of a weighing of the evidence approach. So that's really it that I want to go over for today. This is kind of a brief breakdown. I mentioned I always want to try to keep this to about 30 minutes and then Q&A, because I know you guys all have things to do. But this is kind of where I'm at right now is, the VIX remains elevated. I really would like to see that come down. I'm going to pull up my phone. I think it was at 24 today. And I update it I always look at it on a weekly basis. It's really the numbers I use, but yeah, 24.74. Open the week at 28. Be great if it could go, get below 20 and stay there. The daily rate of change, that chart that I showed you with the kind of that band dispersion, the second chart I showed you, slightly higher than what we want to see, right? Not terrible. It's not terrible, just like, but it's still a little bit wider than what we would like to see. We'd like to see that come down a little bit more, and that would make me feel a little bit, more comfortable in the sense of if someone were to say, hey, what do you think about the market over the next 3 to 6 months? Right now, it's like, well, I think you have to be active, because I think with volatility as high as it is, whereas even though it's risk on, I think with volatility as high as it is, I think things could change really fast right now. Whereas if the VIX was at 12 and someone said, hey, what do you think about the market over the next 3 months? It's like, yeah, there's really nothing to worry about. So as of right now, I think it's just, you have to be a little bit more cautious. Interest rate spike, definitely worth paying attention to, with what's going on over the past 6 to 8 months there, and to see where that's going to settle. It's really interesting that it has gone up as much as it has over the past 6 months. I wouldn't have really expected that. and I think it will probably come back down because again, our the country's debt is tied to interest rates, and I don't think we'll really allow it to creep up much further. But we'll see. If it does continue to go up, I think you could see some more. I think you're going to see volatility increase. I think you'll see a lot of 5 and 7% corrections over like a 6 month period. I think you could see a lot of volatility if interest rates continue to go up, especially with what inflationary assets are doing in the market as well. I think I think the inflation aspect of it will scare a lot of people. On the flip side, intermarket relationships still showing signs of risk on. So I'd say like right now, for the most part, it's, I think it's okay to, take some risk. I think within certain areas though, I don't think the NASDAQ is a place to park a lot of money right now in general. I mean, we don't really have much tech exposure right now. We're more into financials, small cap, mid cap, things of that nature. That's kind of the areas that we like. But momentum still strong, but it has leveled off. That's completely expected though. And what I mean by that, last month I showed a chart of, I showed a chart of the percentage of stocks that were trading above their 200-day moving average. So momentum was so strong because we had such a fast drawdown last March that the slingshot effect was equally as fast. And so momentum built up incredibly strong from the bottom, which was like March 23rd of last year. It built up so strong. So it's totally normal that and expected that type of momentum can't exist for too long. And you don't even want it to, because the problem is if you get momentum that goes like, if you're showing strong momentum like that for a year and a half, that is going to create a bubble. Like that's how bubbles are created. I mean, go back to that chart of the Shanghai Composite where it was up 416% in 2 years, or the NASDAQ up 283% in the 2 years before the dot-com bubble. It's like, those aren't situations that they're great to be a part of if you can get out at the right time. But, that those are bubble, those are definitely what creates bubbles. So it's not really what you want to see. I don't think we're in bubble territory yet, but I just think I think there's just some reckless investing going on. I think we could be in the very early stages of one, maybe. Just stuff to kind of pay attention to. At some point, we're going to. I mean, it's inevitable. It's part of the market, part of investing. At some point, we're going to go through a period of, whether it's a 50% drawdown or a 30% drawdown or something like that. It'll happen. Just a question of when, and are you prepared? And what are you paying attention to protect against it? And so we're, people who have been, in our models knows that we're pretty active. We're pretty hands-on with how we manage money. And then again, things can change at any time. It's important to monitor and follow data. And again, I think the higher the volatility is, I think the higher the chance that things can change at any time. Again, I mentioned if the VIX is sitting at 12, it's like there's just not as much to worry about. With a VIX sitting at mid 20s, it's like, yeah, that's if one little shock happens in the market, it could send shockwaves through a little bit. And so it's important to kind of pay attention to all that stuff. Then last thing, I got to show another disclosure slide here. And then I'm just going to open it up for questions to see if anybody has any questions on anything, any of the slides I went over. I apologize again for my, not being as organized and getting my screen set up at the beginning of the webinar. Like I said, I got new monitors this week, so that stuff was all a little bit different than I'm used to. So any questions at all? Doesn't look like I have any questions. All right. Well, if there aren't any questions, then I guess that will be the end of the March of 2021 webinar. If you guys get a minute, shoot me an email if you get some time, and just let me know what you thought. And if you liked this one more than the one in February, what you'd like to see more of, less of, You know, and again, always feel free to shoot me an email in between these. Let me know if there's something that you want me to focus on, and I can certainly do that. Somebody just asked the questions, will you send out the presentation as well? So it's actually going to be uploaded to our website, and it will be up on the website by tomorrow. So if you go to our website, the one from February is already up there, and this one will be up there tomorrow as well. So I won't send it out, but you can go to our website and get it. So you can watch it as often. When is the next update? So yeah, monthly. So if you're asking when the next webinar is, it will be the first week of April. So, and it's currently the last two I've done on Wednesdays. I don't know if I'm going to stick with Wednesdays. I've been thinking about throwing it to Thursday, and I'll certainly let you guys know. Link to the website. Yep, I'll shoot you an email for that. So I'll shoot you an email when I get off, and that way you can go to the website and watch the one from February, and this one, like I mentioned, this one will be up there tomorrow. So anything else? All right. Well, I appreciate everyone's time. Where will you post next meeting? Well, so I send out, somebody asked, where will you post the next meeting? I always send out an email. And if for whatever reason you didn't get, I sent out 2 email invites for this one. I know for a lot of people it goes into their junk folder. So if you didn't see the emails from this one and I reached out to you personally, then please check your junk email and move the one from your junk email to the inbox. And then you should start getting them from that point forward. Really good question here. Are you concerned about changes in the current economy with Biden in office? No. So I really, let me see if I can find something here. I really remove the political, my thoughts on politics from our decision-making process. And I'll say, I don't want to have to keep everybody on here while I'm looking for a document because I don't know exactly which folder it's in right now. But I'll shoot you an email. The person that asked about the president and then my concern about the economy with that, I'll shoot you an email based on that. And if you want to talk a little bit more in depth about that, we can certainly do that. And it kind of just goes over market returns. I think there's a big misconception about average market returns when there's a Republican versus when there's a Democrat in office. And I know there's people on this call that are on the left and people that are on the right. And I can tell you that we have every single election, we have had clients that have reached out to us. So we had clients when Biden got elected and actually asked, we had, and not just one, we had a few clients that reached out to us and said, hey, I'm really nervous since, Biden's in office. I'd like to go to cash, 100% to cash, because they thought the market was going to crash. They missed out on a enormous gain by sitting in cash for like 2.5 months. And not finding fault, people, I think they get swayed by that. We had the same thing happen when Trump got elected back in 2016. We had clients call us and say, I want to sit in cash. I think the market's going to crash. I get it. I know we're all, have our opinions on things. We follow data. So if the market's going to crash because of president's in office, because he's making changes, then we feel our data is going to show us that. Like, we feel that our data, our momentum signals are going to show us, hey, momentum is starting to turn down. So I'm going to go off of market data, because I can't go off of what people say they're going to do or not going to do and conjecture and things of that nature. So, but I will, the person that asked that question, I will absolutely email that. There's actually 2 people that want that. I will email that to you. And if you'd like to get a little bit more into that, let me know and we can set up a phone call and discuss that. So, anything else? Nothing. Okay. I really appreciate everyone's time. Again, sorry for the first few minutes. That won't happen next time. Thank you so much. Looking to continuously get more and more people on this, every month. And if you have any suggestions for me in the meantime, let me know. Thank you as well. Thanks, guys. Have a great one. Enjoy the rest of your week.